They are talking about impairment. Okay, what is impairment? Is that impairment is, see, you are doing the business. Okay, think like this. You are doing the business. When you are doing the business, what happens? Either you will have different types of businesses, or you will have different types of assets. Okay, different types of assets. Now, unfortunately or fortunately, one of the businesses will not work. Is that it happens? Is that you will have so many different types? One of the business, one of the asset is not giving you response. Okay, response. Keep it in mind. In what, see, you have to, what is the, it has to, what is an asset? It should have a future economic benefit. Is it one of the asset is not giving you economic benefit? Then what you will do? Definitely you will think about that. Okay, you will think about that. As a business, you will divide. You will not mix up the business in two ways. You take the things. You take the cars also. The people who are doing car business, dealers here. You have that one is you have a dealer. They have rent a car. Okay, they will have old used cars. Is that they have all the things. They have some tourism one. Okay, they will like this. They will have different segments. All segments are separately. They will not mix up the things. Okay, all segments are, even you take the cars. Some are heavy vehicles. They will have a separate department who deal with heavy vehicles. They will a separate department who will be the sports car. They will a separate person will be there who will be doing with sedan cars. Is that you are talking about the things? We will say how we are dividing. There are separate people who are doing with a corporate business. They are talking in terms of retail business. There are separate people who are dealing with the government sales. Isn't it? Now, at some point of time when you are doing the business, there will be some impairment. Impairment is not listening. Impairment is you are not listening. You are not responding. If that is the case, it is a loss. How you have to treat that loss? Okay? Simple business. In the impairment loss, we are dividing the chapter under two things. The first we are talking in terms of impairment, and the second we are talking in terms of cash generating units. Is that cash generating units? In the examination, again I am saying it will be for 6 marks. It will be in section A or section B. Okay, it will be in section A or it will be in section B. Again, they will ask some question on concepts and some questions on calculations. Take it a one question will be on concepts, 2 questions will be on calculations. Is it right? There are 2 things. The first one is impairment, and there is the second one is cash generating units. Okay. Now, this is what we are doing. Calculate, define, calculate for how the impairment loss, account for reversal of impairment loss of a individual assets. What happens? See the thing. In some cases it happens. You see the car. Okay. I am giving an example of car. You are having a car. Okay. When you will say that it is going to be for 10 years. Okay. It is what happens. Initially the value of the car will decrease, but you are having a good maintenance, good conditions. Okay. After that, this will become a classic car. Is it right? This will become a classic car. Everybody, what will happen? The value will not decrease. Either the value will remain same, or the value will slowly will increase. Classic cars, you see, people are there. They are very passionate to buy cars, old cars. Okay, now this is what sometimes what will happen, there will be a loss, there will sometimes reversal of loss means the value of the asset, is it, value of the asset will also increase, there is a possibility, is that there is a possibility. First we will do this, then we will talk about cash generating units. Okay, cash generated, both are calculations, keep it in mind, focus on things how it will work. Is that what they are saying when we are doing the things, is that impairment of assets, IAS 36. Okay, IAS 30. Here they will not ask, I am telling very clearly what is there, what is not there. Here they will not ask about IAS 36, all those things. But if you go see, you have FR, the moment you go for SBR, Strategic Business Reporting, the only thing is they will, see here in FR you take the thing, here 75% is calculations, 25% is theory. In SBR, you have 25% is calculations. Understand point? 75% is theory. It is not theory, it is application. Whatever you are doing calculations, you have to write. Okay? See, this is the difference. Here they will mention IAS 36. It doesn't mean that you should not remember this. You have to remember IAS 36, impairment of assets. What are the reasons impairment? Okay, how you are going to measure the impairment, and most importantly, what is the impairment of cash generating units? Is it right? Cash generating units. Fine. Now it says that what is the objective of 36? It says that whatever is given in bold letters, keep it in mind. When you are revising it, you read two times. The rules is that are carried out at no more than recoverable amount. Is it what happens? See the thing. Now what we have learned, revision I am doing. You will have the initial cost. Is it right? You will have the initial cost. Then you will calculate depreciation. Is that initial cost minus depreciation, you will have a carrying amount. Okay, carrying amount, this is the carrying amount. In the carrying amount, how much you are going to recover? Is that sometimes what will happen, in order to, you want to sell this asset, okay, you want to sell this asset, you will take the carrying amount. Carrying amount, you will have some selling cost. Is that you have to pay some selling cost. What will happen? It is a recoverable amount. How much you are going to be recover? How much you are going to realize? Realized amount will be how much? Realized amount. Assume, take an example. Realized amount is 9,600. But when you sell it, it will come to how much? It will come to 9,000. This is the selling. Is it? The carried out not more than recoverable amount. Is it? The balance of 600 is, it is not a depreciation, it is not amortization. The balance of 600 is, we are realizing less than the amount, it is called as a impairment. Is it called as a impairment? Now, this is what it happens. So many reasons. Is that so many reasons are there? What it says, IAS 36 applied to all assets. It applies to all except, other than, except. Is it right? Inventory, it is not applying to construction contracts, IFRS 15. We will cover this IFRS 15. Okay. Previously it was revenue, now it is construction contracts. Is that? Deferred taxes, it is not applying. It is not applying for the employee benefits, whatever you are getting, pensions, all those things. Financial assets, it doesn't apply for IFRS 9. Financial instruments, okay, it doesn't apply to financial instruments, and it doesn't apply to investment property, what we have done in chapter 2. Okay, Non-current assets classified or held for sale, IFRS 9. 5. Is it? It will not apply to these things. Don't worry about that. Wherever it is important, immediately I will put the purple color. Okay? Means it will not apply to this type of things. Keep it in mind. Maybe they will ask you in MCQ. I am saying very clearly in section A. Why I am saying section A? It is a theoretical question. Okay, it is a theoretical question. All theoretical questions will be there in section A, my MCQ. Okay, all theory means they will ask which two of the following is not applicable, which two of the following is applicable. Like that they will ask. Okay, again I am repeating: inventory, construction contracts, deferred tax, employee benefits, IFRS 9 financial instruments, IFRS 40. IAS 40 investment property, and IFRS 5 held for sale. Okay, it is little bit too early to get the thing, but slowly we can get that things in our mind. What is impairment? An asset is impaired, not responding, impairment, not hearing. Is it? If its recoverable amount is below the value of currently shown in the financial position. What is the value we are showing in the financial statement? We are showing the value is carrying amount. Now you understand what is the carrying amount. Carrying amount is the amount which you are going to show in the final. I am very much worried about this. Okay. Now it will be very clear for you. Initially it was not. Is it right? What is the cost minus depreciation? You will have we will say, some people will say net book value. Is it? But as per the IFRS and IAS, as per IFRS, we are not using the word net book value. We are using the word carrying amount always. Is it? It is below the carrying amount. Okay. Recoverable amount is taken. What is the recoverable amount? Fair value less cost to sell. Is it? Now you see the new words. We are talking about net realizable value. You want to sell an asset, is it right? You want to sell an asset. What you will do? You want to sell a property. Okay, you want to sell a big real estate, big property. Some buildings are there. You will sell. You will go through an agent. You have to pay some commission. Is it right? You have to pay. That is the selling cost. Okay. Now another one is value in use. It is a new concept. Wherever it is a new concept, I will tell you this is a value in use. If you are not selling, what is the value in use? Is it? What is the value in use? Every time you cannot say that you cannot come to a conclusion that at the time of selling. Sometimes you will not sell, but you want to know what is the value of the asset. Is it that you are having properties and you will say that as what is the value of the asset? Then what you use? You use the concept as value in use. Fine? Most important, value in use. A impairment exists. Your carrying amount is greater than recoverable. Carrying amount is 9,000. Recoverable amount is 8,000. Is it right? Now what happens? Greater of fair value less cost to sell. Is it right? Fair value less cost to sell. You are going to sell, recoverable amount is 800. Is it right? Now what happens? 8,000 is the fair value. Okay. You are going to pay some 400 as the selling cost. Okay. Selling. What will happen? It is going to be 7,600. If you don't sell, what is the value in use? Value in use will be 8,000. Is it? Value will be in use will be 8,000. Fine. Greater of. This is what it says. If you are selling it, fine. If you are not selling it, you are using it. You are using the value in use. This is the most. Are you clear about this? Carrying amount should be greater than the recoverable amount, and what we have to do? We have to say what is the, if you are selling, fair value less cost to sell. If you are not selling, it is value in use. Is a measurement of fair value less cost to sell. Is that it is what it says? Measurement may be a binding sale agreement. You will have, yes, this much, there is an agreement that I want to sell it. I will keep that one, the same amount, 8,000. The current market price less cost of disposal, where the active market will exist. It is nothing but, we are talking in terms of what? We are talking in terms of IFRS 13. What is the conditions of the what is the conditions of fair value? Yesterday we have done, last class. What we have done? There should be intention to sell. Is it? There should be active markets. Is it? Active participants. Is it? Active participants. You should have a, this is what the condition says. You should have an intention to sell, and you should be active. You should have sufficient buyers. Is it? You should have sufficient buyers. People should be there, that people are willing to buy. Okay, this is what it talks about the IFRS 13. Is it right? Fair value means, now I will use the word. Is it right? They use the word arm's length transactions. Neither it should be overpriced, nor it should be underpriced. Is it right? Your price is price. That is a, you see the thing. I will give you example like this. OLX is there. You have eBay is there. Is that you have so many online portals are there. Is that what happens? Their price is very reasonable. Is that there is price, neither it will be overpriced or it will be underpriced. Overpriced people will not buy. Underpriced it will go like a hot cakes. Okay. Measurement of, this is the first one. Is it right? This is the first one. Wherever it is a reading, read it. It is very, very specific. It says value is determined estimating what is the future cash inflows and outflows. Is that what is the value in use? Determination of, you are estimating, you have the asset with you. You will say what are the inflows and what are the outflows. Is that value in use? I am very, very slow here. Is that estimating future cash inflows and outflows from the use of the, if you are using the asset, what will be the inflows and outflows. And the ultimate, if you want to sell, is that what is the depreciation? The concept is cost minus residual value. Is it right? What this is the depreciation? Is it right? This is divided by life. Sometimes what will happen? There is a ultimate disposal. Is that? And the ultimate, and it's we are selling it off and applying a suitable discount rate. You have any idea about discount rate? Yes or no?
It's interest rate.
If there is no, tell me no. Yes, say me yes. Don't waste time.
No, doctor.
Okay, fine. That's good. If you don't have, now what is the discount rate? Discount rate is, you have the present value. Okay, you are going to calculate the present value. Discount rate is nothing but the at what rate at which value of money will decrease. There are so many definitions. Is it right? The discount rate is also called as a risk factor. Risk. Okay. Discount is a risk. What is the amount of risk you are taking? And in financial management or financial accounting, there is a time value of money. Value of money will never increase. Value of the money will decrease rather than increase. You are paying what last year you have paid and what this year you are paying. Definitely you are paying more. You are not paying less. Okay. Any product, time value of money. This is what we are talking about, the discount rate. They will say, now people, you take the things. If you are working anywhere, you are working in accounting profession, I will say which one is most. If somebody is saying 6%, 8% or 10%, Where the value will be more, where the value will be less? You are, see, assume, make it very clear. Loan. If somebody is offering loan at 6%, 8%, 10%, which one you will take?
From the interest.
Yes.
6%.
6%. Okay? Very clear. You are making an investment. Is it? Which one you will take?
10%.
Huh?
10%.
10%. Okay? Now, I will show, now I told you just like this, okay? I have to make sure present value, is it right? I have to tell about present value. Present value says that C divided by 1 plus R, okay? C divided by 1 plus R to the power of T, okay? Assume C is going to be 100, R is going to be 6%, 8%, 10%, is it right? Now you see the thing, take the calculator. 100 divided by 1.06. How much you will get fast? Very fast. 100 divided by 1.08. 100 divided by 1.10. How much you will get for the first one?
94.33.
94.33. Okay. Second one?
92,593.
Third one?
90.909.
Okay, now you see the things. Don't go by the 10%. If you go by 10%, the value is less. Okay, the value is less. This is proven by this is one standard formula that is there for everyone. You will use this multiple times all over, anywhere you will use this one. Anywhere you are using. If you are doing ACCA, you will do it. At least you will use this formula million times. I am telling you this. We will say that yes, we have said that okay, loan is 6%, fine. But if the value of R, is it right? Value of R is less, the present value will be more. If the value of R is more, the present value will be less. This is the rule. So when you are doing the things, make sure that we don't go by 10%. 10% is high risk. 6% is less risk. Okay, 6%. You have taken the what one rule applies to loan, other rule applies to investment also. Okay, it applies to here. We admit here the value will be less. We'll cover this at a later stage in detail. Okay, we'll cover this in detail. Applying a suitable discount rate. Okay, what is the discount rate of cash flows? 6%, 8%, 10%. They will give you in the question. Cash flow relating to financing activities or income taxes should not be included. We should not include what value in use, anything related to financing, anything related to borrowing, or we are talking about any investing, we should not include. And income taxes also we should not include. Is it? Most important thing is fair value less cost to sell and value in use. In the question, they will ask both the things. In the question, they will ask both the things. What is the calculation part? Okay, calculation part. That much is there. Nothing beyond that. Okay, nothing beyond that. Now, what they say that see now you understand. The following information related to carrying amount is how much? 100, 150, 1 to 120. Net realizable value. Okay, net realizable value. Salaam alaikum Salim. Okay, carrying amount is how much? Net realizable value 110. It is more, it is less. Here the net realizable value, see what we are saying, be very clear. Carrying amount. Okay, carrying amount. Is it right? How much is the carrying amount? We are talking about 100, we are talking about 150, we are talking about 120. Okay. Now, net realizable value. We go back to the figure what we are saying. Is that recoverable amount? Is it right? How much is the net realizable value? Here it is 110. Is it right? It is 110. It is 125. It is 100. Okay. Value in use will be how much? Value in use is 120, 130 and 90. I will put very clear here. This is value in use. This is net realizable value. Net realizable value is otherwise called as what? Otherwise called as a fair value less cost to sell. Okay, fair value less cost to sell. What is the recoverable amount of each asset? Calculate the impairment loss. Is that what is the recoverable amount? Now, how much is the recoverable amount? We have to take higher, the greater value. Is it right? We have to take the greater value. That is what it says. Is that what it says? We have to take the greater of. Is that we have to take greater of. Fine. Next. When we are taking greater of, how much is there? See, here what we are taking, the recoverable amount, what is the impairment loss? Is it right? Impairment loss. Now you see the thing, carrying amount is 100, it is 120. Here the impairment loss is there. It is impairment loss is there. It is plus 20. Is it right? Impairment loss is there? No, it is not. There is no impairment loss. Is it right? Now, understand my point? Carrying amount is 100. The value in use how much? Greater of 110 and 120. We have to take 120. If we are taking 120, is there any impairment loss? No. What it says, the recoverable amount carrying amount should be greater than. Is that the carrying amount should be greater than? Carrying amount is greater than this one? No, carrying amount is less than. Okay, here the carrying amount is less than. When there is less than, there is no impairment loss. Is it? There is no impairment loss. Are you clear about this? Are you clear about this?
Yes,
Can you
sir.
explain it again?
Pardon?
Can you explain it again?
Yes. See, what the rule says? Rule says that carrying amount should be impairment. What is the definition of impairment? Carrying amount should be greater than recoverable, greater than net realizable value or value in use. Here what's happening? Your carrying amount, your value of the asset is 100, but when you want to sell it, you are getting how much? 110, or you are having 120. Is that now your value of the asset is 100, but you are getting more. Is there any loss for you?
No.
No. Is there? There is no loss for you. There is no loss. Okay. It is no loss. Now second, see the second. Carrying amount is how much? 150. Is it right? Carrying amount. What is the carrying amount? Cost minus depreciation. Is it right? It is shown in the financial statements. Okay. 150. But when you want to sell it, how much is there? You are getting 125. Is that? You are getting 125. But if you don't want to sell, you want to use it, how much you are getting the amount? 130. You have to take which is greater. Which is greater among these two? 130. Is it right? Which is greater among these two? 130. Now, if the 150 is the carrying amount, you have to compare with the amount which is higher. You should have to compare amount with the higher. When you are comparing amount with the higher, the value is 150, but your value in use is how much? 130. How much is the loss you are getting? You are getting a loss of 20,000. This is a impairment loss. Okay, this is a impairment loss. Fine. The third situation. Carrying amount is how much? 120. Which is greater here, 100 or 90? Which is greater here? Here?
100.
Yeah.
100.
Then you have to compare with the greater amount, okay? You have to compare with the greater amount, okay? You have to compare with the greater amount. If you compare with the greater amount, again there is a loss. How much is the loss? 20,000. Isn't it? You have to compare with the loss, okay? You have to compare with the greater value. Now you see the all three situations. You are seeing the all three situations. The first situation is carrying amount is 100. This much you understand. All things will be done, inshallah. Okay, this much you have to understand. Okay, 100 is always you have to compare. Carrying amount will be the base. If these two, you have to see which is the greater value. Okay, in these two we have to see which is the greater value. Here carrying amount is less. The net realizable value is more. The concept of impairment loss will never come. Okay, the rule is not satisfied. Second one, carrying amount is 150. Or immediately you have to know which one is greater. Greater is 130. Then you have to compare with the 130. You should not take the lower value. How much is there? Loss is how much? 20. Now carrying amount is 120. Here which is greater? Net realizable value is greater. Okay, net realizable value is greater. How much is 20? Difference is how much? 20,000. It is a loss. Is it clear to you?
Yes.
Is it Hussein, Salim and Sumaya? Is it okay with you?
Yes. Just it.
Fine. This much is there. If you understand this, almost we have done what the basic concept we have done. Is it right? Nothing is there. Indicators. What are the reasons? Okay. What are the indicators? That IS requires that each year, each reporting date, is it right? Each reporting date, an entity must assess whether happen. You have to do every year. Each reporting date means you have to do every year. Okay. Indications may be derived within the entity. There are some reasons for internal sources. There are some external. External factors or internal factors. What is the external factors? Why the value will decrease? They decrease because more the market value, sometimes market value will decrease more than expected. You take the car, as simple as that. Is it you are buying a car. The moment you buy a car, you take the delivery of the car, automatically what happens? The minimum 10% value will decrease. Minimum 10% value immediately. Okay, immediately the value will decrease. Okay, you take any asset. Okay, you take any asset, it will be except land. Okay, except land and buildings, fine. But machinery, technology, is that everything is like that. Changes in the technology. Why value will decrease? Technology market, economic, legal environment. Is it right? What will happen? You see the gadgets. Okay, you see the gadgets. Every year the value will decrease. When they are launching, keep it in mind. iPhone, Apple, they will launch iPhone. When they launch iPhone, they will say that the value is going to be 500 reals. Is that they say it? But what will happen? Initially the value will be on the higher side. Slowly what will happen? New technology will come. The value of old technology will decrease. This is called as impairment. Okay, this is called as impairment. Interest rates are rising. Now you see the thing. I will say we have done 6%, 8% and 10%. 6% value is less. As the interest rate increases, okay, as the interest rate decreases, value will decrease. Is that as the interest rates increasing? Well, see, I am not talking anything. I am talking about very clearly what is the reality. As simple as that. Okay, what is the reality? Sometimes, now you are talking about technology. Okay, we are talking about technology. Economic market, Is it when there is a recession? Is it when there is a recession, value will decrease, demand will be less. If some legal environment, pollution, there are some rules will be imposed, immediately value will decrease. I will give you an example. This is it right? I will give you the things. What happens? What happens now? You have a lot of electrical scooters. You have, is it right? You call it electric scooters or electrical cycles. Is it right? Electrical cycles are there. What happening? Value is increasing. Is it? Demand is increasing. What are the other things? The value will decrease. Is that normal cycle demand will decreasing. The electrical scooters, because of technology, as simple as that. So what you are doing? You are talking about saving the cost. You see, for everything, wherever you are discussing, you discuss with the current environment. Then only you will understand the subject. Okay? This is where happens. This is the reasons why the value will decrease. The reasons for impairment. These are external sources. What are the internal sources? Keep it in mind. We are going to cover next week or after vacation, after break. I will start section A and section B. Understand point? One day I will dedicate for section A and section B. I will start questions and answers. Okay? There I will tell you in advance, because almost by the time we will complete 7 to 8 lectures, we will be in a good position to do question answers. Okay? So before that I will tell you, revise and come. And you have to go through each and every lecture, and I will explain, you have to give me answer. This will happen after Eid break. Understand my point? I am telling you well in advance. Okay, somewhere down after 15th April. These are internal sources. Obsolescence, okay, outdated, damage is happened. Is that you will come across. Home center will give sale. When they are giving sale, they will not give sale on new products. Okay, they will not give sale on new products. They will give sale on what? They will give sale on old products. They will give sale on damaged products. Take my word, this is the reality. If something is damaged, they will say 60% off. If more damage is there, 80% off. Is it right? People will say that yes, there is a sale. No, they are obsolescence, outdated. They will never give sale on new products. Change in the way asset is used have occurred or imminent. Is that we are using the asset? Is that you are talking about? See, gadgets, technology. Is it right? Technology. You are using advanced technology. The old technology will become outdated. Is that? Do we prefer new technology? Is that value will decrease? You don't want to buy. Is it right? You don't want to buy a car with a model of 2018. If there is a 2018 model is there, on that model they will give sale. That new model they will not give sale. Economic performance of asset anticipated worse than expected. Is that you will always make it a point. You will do cost and benefit analysis. Okay? If not giving good returns, is not useful. Why you will retain that asset? You don't want to retain asset. You want to replace the asset. You will not retain, and is it? You will not retain the asset. What you will do? You will make sure, we are very business oriented. Okay? What you will do? You will replace the asset. Is it? Those are the internal factors. Fine. These are the external factors. These are the internal. Now what we have covered again, we have covered something in value, fair value less cost to sell, value in use. We have done with an example. Okay. We have done what are the reasons of impairment. External factors, sources, internal sources. Annual impairment. Where there is no indication of impairment, no further action need to be taken. If you don't think impairment is not required, don't take. Exception. Is it goodwill acquired in business combination? Goodwill will be impaired. Keep it in mind. I am going to cover this in chapter 17. I am telling you in advance. Okay? There is a goodwill impairment. The value of the goodwill will decrease. An intangible asset with an indefinite useful life. Is it? With an indefinite finite life, amortization. Indefinite life, impairment. Intangible asset not yet available for use. You are not using the intangible asset. You are not using the asset in simple words. If you are not using, you have bought some car and you are not using the car, car will get rusted. Is that the moment you use the asset, the value will increase. If you are not using the asset, the value of the asset will decrease. Is it? IS 36 requires annual impairment reviews for these assets. They are saying specifically for these assets you should not do the annual impairment, irrespective whether there is a indication of impairment. Irrespective whether it is there or not, you have to do impairment review. For what? You have to do for goodwill, you have to do for any intangible asset, indefinite life, is it? And you have to do for which are not in use. Is it? Next, recognition and measurement. How you are going to measure, how you are going to calculate. Okay, where there is no indication of impairment, an impairment review should carry out same thing, recoverable amount. You know, how much you are recovering. Recovery amount is nothing but fair value minus cost to sell. Is it? Fair value minus cost to sell. I am writing this because these are the inputs we need. Okay, the assets should be returned down to recoverable amount. Is that the asset should be, means you have to reduce the asset to the recoverable amount. The impairment loss should be immediately recognized. Where we are using impairment loss, profit and loss account. Understand my point? Whenever there is a impairment loss, it is in profit and loss account. Now, treatments will make sense. It is not difficult, okay? The only exception is that impairment reserves in previous gain taken to the revaluation surplus. If there is any impairment reverses, anything happens, gain, okay, means there is a possibility that the value will decrease, there is a possibility that the value will also increase. If there is a increasing, it is going to be gain, impairment. It is going to be shown where it has to be shown in revaluation surplus. Yeah? In this case, impairment will be taken to revaluation surplus, means how you are routing, is it right? If there is any gain, what you will do? You will take into revaluation surplus. If you remember rightly, in chapter 2, we have done the same thing. If there is a gain, you have to do revaluation surplus. If there is any loss, first you have to deduct from revaluation surplus. Is that? First you have to deduct from revaluation. Remember, this is what we have done in chapter 2. Specific asset, same asset, okay, same asset. Any gain, you take revaluation surplus. Any loss, first you deduct from the revaluation surplus. If there is no balance in revaluation surplus, then you are going to take it to the profit and loss account as a loss. Is it? I will revise the moment the point will come. I will revise the previous lectures also, so that you can refresh yourself. You can refresh. In this case, impairment loss first will taken to the revaluation surplus, and so disclosed in the OCI. Is that? Gain will be shown in OCI. Okay, gain will be shown in OCI. Okay, other comprehensive income. Okay, other comprehensive income. Until the revaluation gain is fully exhausted, revaluation gain fully exhausted, you will show. Then any excess will be shown in the profit and loss account. I am putting this very clearly. This same point we have covered in chapter 2, IAS 16. Means these are the things where you can really encash. These are things that will be tested. The moment we do question answers, you will come across the question answers will be comparatively easy, subject to the condition that we are knowing the rules. Okay, subject. Now, you see the things. Test your understanding. Read this one. First, read the question. Identify the recoverable amount of the car and any impairment required. Read the question. What they are saying, an entity owns a car, okay? An entity owns a car that was involved in an accident at the year end. It is barely usable, it is not usable. So the value is estimated how much? The value is how much? Value in use. They mention very clearly, okay? They will mention, they will give all the information completely, okay? They will give all the information complete. Value in use. How much is the value in use? Value in use is how much? 1,000. Okay, value in use is how much? 1,000. Is it? Value in use is how much? 1,000. However, the car is a classic and there is a demand for the part. This results in a fair value less cost to sell. Is it? Fair value less cost to sell. How much is fair value? Fair value less cost to sell. Is it that? How much is fair value less cost to sell? It is 3,000. Is it? It is 3,000. This results in a fair value cost. The opening carrying amount. Carrying amount is how much? Carrying amount is 8,000. Okay, carrying amount is 8,000. Fair value, net realizable value is 3,000. And value in use is how much? Value in use is 1,000. Fine. Now, the opening carrying amount is 8,000 and car is estimated to have a life of 8 years. Is it? The car is a, now, what happens when entity, see the dates, is it right? The opening carrying amount is 8,000. At the year end, okay, at the year end, fine. It has happened when? At the year end. Now, what we have to do? We have to compare immediately? No, we cannot compare immediately, okay? At the year end means first what we have to do, this is the value at the year end, okay? It has been done at the end of the year. Now, what is the initial cost? Initial cost is how much? This is step 1. Okay, write down. I will ask you someone to send me the screenshot. Understand point? Very specifically, in a very friendly manner, I will ask you. That is our understanding. Okay, that is our understanding. Initial cost is how much? Initial cost is 8,000. Okay, see, it happens at the end of the year. Is it right? It happens at the end of the year. Means you have to calculate depreciation for for year 1. Is it year 1? How you have to calculate depreciation for year 1? They say it is 8,000, cost is 8,000, no residual value divided by 8 years. Now, how much is there? 1,000. Is it right? Now, when 1,000 is there, what is the carrying amount? This is the carrying amount. Okay, this is the carrying amount. This is the carrying amount at the end of the year. Okay, this is the carrying amount at the end of the year. How much is the carrying amount at the end of the year? 7,000. Now you compare. Okay, now you compare with the NRV and value in use. Is it? Now, how much is there? How much is the impairment? How much is the impairment now? Tell me. We have to take NRV or we will take value in use? Which one is greater?
NRV.
NRV. We will take NRV. Okay, we take NRV. We compare with NRV. Okay, we compare with NRV. What is the difference is there?
4,000.
4,000. This 4,000 is impairment loss. Is that recoverable amount is how much? Recoverable amount is 3,000. Net realizable value is how much? Net realizable value is 3,000. Okay. Recoverable amount is 3,000. Impairment loss is how much? Impairment loss is 4,000. Are you clear about this? Yes. Salim, Hussein, Mazin and Samir. Is it okay?
Doctor,
Yeah, tell me. I will explain you. No problem.
the recoverable amount is always equal to the NRV?
Yes, always equal to the NRV.
Okay.
Is it right? Recoverable amount is always fair value minus less cost to sell. Net realizable value. Net realizable value is nothing. See, we are using the words differently, but see, I will put like this. Is it right? I will put like this for your understanding. Okay? Recoverable amount. Is it right? Recoverable amount. Okay? Or net realizable value. Yeah, net realizable value. Both are same. Okay? Both are same. Is it okay?
Yes.
Okay. I will give you a complete clarification so that you should not have. Don't get tomorrow in some question they say net realizable value. In some question they say recoverable amount. Don't get confused. Both are same. Okay. Are you clear about this?
Yes.
Yes. Any doubt you ask me. I really feel happy that you are asking. When you understand, you will have doubts. Now, second one. An entity owns a property which was revalued. Is it right? Dates are important. 31st March. Okay, 31st March 2003. They have made a revaluation. Is it right? They have made a revaluation. What is the value? The value is 500,000. Is that the value is how much? 500,000. With a revaluation gain of how much is the revaluation gain? Revaluation gain is how much? Revaluation gain is 200,000. Is that revaluation gain is 200? Has been recognized in OCI and recorded in SAR. At 31st March 2005, the carrying amount is how much? The carrying amount, is it right? The carrying amount is how much? 460. Recoverable amount is how much? Recoverable amount is how much? Recoverable amount is only 200,000. Is it right? Recoverable amount is how much? 200,000. What is the amount of impairment? Can you tell me please? We don't have value in use, okay? We don't have value in use. They have not given value in use. Is it right? Value in use they have not given, not given. Then if it is not given, you have to compare with what? You have to compare with the recoverable amount only. Carrying amount is how much? Carrying amount is carrying amount. Is right? Carrying amount is how much? Carrying amount is 460. Okay? The recoverable amount is NRV. Recoverable amount is how much? Recoverable amount is 200. Is it right? How much is the impairment gain or loss? We will not have impairment gain. We will have impairment loss. How much is the impairment loss?
260.
260. Is that 260? Are you clear about this?
Yes.
Yeah. This is the first part. Now the things are. Is that this is the, I will put like this is the data given. Is it? It is given. This is the step 1. Is it right? Now, what they are saying, at 31st March, the property is revalued at how much? 460. Is it? At 31st March, the property is revalued at how much? 460. Fine. Now, if they have properties revalued at 460, what we have to do? How much is the impairment loss? Impairment loss is how much? 260. Is it right?
Yes.
Impairment loss is how much? 260. Okay. Now, what is the revaluation amount? Recoverable amount?
200.
200. Okay. You have 260. Is it right? You have 260. Is it right? You have 260. This is the this is step 2. Okay, this is step 2. This is your impairment loss. Is it right? This is your impairment loss. Now, how much was the gain last time they have a revaluation gain? How much they got revaluation gain? How much was the revaluation gain? They are already having some balance in revaluation gain. Okay, they are already having some balance on revaluation gain. First you have to check if they are having any balance in revaluation gain. How much is the balance they are having in revaluation gain? They are having a balance of how much? 200,000. This is the, already they have a balance, is it right? They have the balance. Now, if they have the balance of 200,000 and they have a impairment loss is 260, first you have to deduct the loss from the balance. You already have the balance, is it right? Now you cannot say loss is 260. You whatever the revaluation balance, this you have to divide, okay? This amount you have to divide. First you have to deduct how much. How much is the amount, that much only we can use, and you have to make this amount 0 first. Okay, you have this balance you have to make 0 first. Now how much is the now what is the revaluation impairment loss? Impairment loss will be how much? 60,000.
60,000.
It is it is a loss, okay? It is the remaining balance. It is this loss you have to show where? You have to show in profit and loss account. The rule says, I'm going back to the rule. Is it right? See the thing. This is the rule. You see the thing. This is the rule. In this case, the impairment will be first taken to revaluation surplus, 200,000, and so disclosed as OCI until the revaluation gain is fully exhausted. Then any excess should be taken to where? Profit and loss account. Is it any excess to be taken to where? To profit and loss account. We are applying this rule here. Is it right? We are applying this rule here. Is it right? See, as simple as that. You have done revaluation. Revaluation, there is a balance of 200,000. We cannot shuffle that amount, okay? We cannot shuffle the amount. We have done this revaluation in 2003. Now it is 2005. Now it is loss. If there is a loss, first you have to identify. If there is any surplus is there, yes, there is a surplus of 200,000 is there. First you use that surplus amount. Make that surplus amount, if how much you can. Sometimes what will happen, I'm giving an alternative. You have a revaluation of 200,000. You have now you are doing a impairment loss 160,000. You will have still 40,000 will be there in revaluation surplus. Still 40,000. You may use this 40,000 in future. Is it right? You may use in future when, if there is any loss will be there. Is that? If there is any loss, you will use in future. If there is no loss, you will not use. Okay. The only thing is the rules has to be applied. Is that? First you have to calculate impairment loss. Step 2, we have to distribute it. Anything is there for the you have any surplus, first you have to use for that surplus. Then subsequently, if still remaining balance is there, then you have to transfer to profit and loss account. Is it clear to you? One, two, three, four. Fast.
Yes, doctor.
Okay. Next. Keep it in mind. My only purpose is you have to revise this. You understand this. Okay, that's very important. We will test our understanding in the questions plus in the question answer session. Is it right? We will take the exam questions. We will do exam questions and we will work out on exam questions. Then you will the same rules we will apply. Now, reversal of impairment loss. Yes, the calculation is based on the prediction, only estimations. Is it right? The calculations is based on the estimation. What happens in future? Sometimes actual events, sometimes it will be better, sometimes it will not be better. Okay, fine. Okay, that's not a case. Impaired assets should be reviewed every year. They are telling you this every time. Whenever you are making impairment, you have to do it at each reporting date every year. A reversal of impairment is recognized immediately. You should not say that I will do next year. Okay? As income in profit and loss. If the original impairment was charged against surplus, immediately we have to do. The reversal must not take the value of the assets over the depreciated amount. Very interesting, and this they will ask you in the question. Now I will tell you this. Okay, now I will tell you this. You have an asset, is it right? You have the asset. When you have the asset, you have an asset of 10,000. Okay, minus depreciation. Okay, minus depreciation 2,000. How much is there? I will taking it. This is the carrying amount. Okay, carrying amount. Now you have, in some cases, you have a loss. Okay, you have a loss of how much? You have a loss of impairment loss of 1,000. I will not take 2,000. I will take impairment loss is 1,000. Okay. Now, what is the value? 7,000. Again, see the permutations and combinations. See, it happens in real life. Now what happens? You have a impairment gain. Okay, value has been increased. Okay, value has been increased by 9,000. Okay, value has been increased by 9,000. Okay, 9. How much is the gain? Gain is 2,000. Is it right? Gain. Now value is 7,000. Is it right? You cannot, already how much you have taken a loss? 1,000. Now you cannot recover more loss. You can recover the loss to the extent of how much? You can recover the loss to the extent of 1,000 only. Is it right? You cannot increase the value of the asset. Is it right? The reversal must not take the value above depreciated historical cost. Is that you cannot take more than, the amount is 7,000. You cannot revalue and say that yes, I will take more than 7,000. That's not permissible. This is a very, very important rule. Is it? This is very, very important. They have tested this so many times. Is it right? Whichever exam question you are doing, you will have this point with us. The amount would have been the original impairment. Has never the amount it would have been if the original impairment have never been recorded. Means the original impairment is not going to be recorded. What you have to do, the depreciation that have been charged in the meantime must be taken into account. How much you have charged the depreciation, that much amount you have to take. Means it is a little bit complicated. When you are going to say that, people will do this. Okay, they will increase the value of the asset and they will decrease the value of the asset. Decreasing is easy, increasing is difficult. You cannot say, but when you increase the things, what will happen? Your OCI will increase, other comprehensive will income. Your OCI is increasing, definitely your equity will increase. Your equity is increasing, your assets will also increase. People can do this, is it right? People will do this just to convert into profits to losses, losses to profits. If there are losses, you will say that yes, my value is 400,000. Who will question me? Who will not question? Nobody will question me. If everybody will go on doing like this, then what will happen? There will be a creative accounting. People will manipulate the accounts. So there is a rule for, strict rule for whenever there is a reversal. When you have identified loss is 100, is it? When you have identified loss is how much? 100,000. You have a gain of 2,000, is a revaluation gain. Take 1,000. Okay, take one. Gain is how much? Gain is 1,000. Next time, you cannot go beyond, you cannot recover a loss of 2000. Your balance is only 1000. You cannot go beyond 1000. Okay, you cannot go beyond 1000. That means you have to be little bit careful when you are doing this. Just give me time, I will explain with example only. Yeah, the depreciation charge for future periods should be revised to reflect the change carrying amount. Always the depreciation should be calculated on the revalued amount. Is it right? Always. This is the condition for IAS 16 and this is the condition for any other asset. Rules are same. Where the rule is same, I will tell you. Whenever there is a revaluation, wherever there is a revaluation, the depreciation should be charged on the revalued amount. Okay, the depreciation should be charged on the revalued amount. Fine? Now, are you clear about this?
Yes, Doctor.
Yes, Mazin.
Yeah, Doctor, clear.
Little bit. I know the response. The moment I listen your voice, I know you find little bit more clarity you need. Okay, I know, I can understand. I will focus on that. The impairment loss recognized for goodwill cannot be reversed. Again, I am saying I will take this in chapter 16. Okay, anything that. The reason is that once purchased, it has become impaired. Again, you cannot increase any amount. Okay, just keep it in mind. What is a recoverable amount is likely to be increased in internal generated goodwill. Again, I will say the reason for this is that once purchased goodwill has become impaired, any subsequent increase in recoverable amount is likely to be an increase in internal. Means what we have done in the last session, internally generated goodwill is not recognized. If you are increasing, it means you are increasing by your own, and that is not acceptable. Rather than reversal. Fine. Internally generated, again they are saying internally generated goodwill cannot be recognized. External indicators of what are the reversal? Is that we are talking about the reversal. The value of the asset will increase, market value will increase. There are some favorable technologies, some same thing, economic conditions, legal environment. Is that if something positively, the value will increase. Okay, there is a rare cases. Okay, decrease if interest rates are decreasing, the value will increase. Understand? Now you understand 6%, 8%, and 10%. Okay, that is the reason I mentioned that calculation there. Internal indicators, favorable changes. What happens? You have kept you have, is it that you have some resort? Okay, you have some resort. Okay, you have some resort. You are not using the resort. Value of the resort will decrease. The moment you are using the resort for commercial purpose, is that you are using the resort for commercial purpose. What will happen? Your cash inflows will increase. Automatically, your cash outflow expenses will also increase. Automatically, the value of that asset will increase. Okay, improvement of the asset economic performance. Fine. These are the reasons why there is a possibility that there is a reversal will happen. Fine. We'll complete this. We'll complete this quickly. Quickly we will do this. Okay. Then we will tomorrow next class we will do cash generating units. Is that this is only now we have done major part. Okay. We have this is the major part. Test your understanding 1 and test your understanding 2. How there is a impairment loss and how you have to allocate impairment loss. Okay, this they have given an example. They have Boxer purchased a non-current assets to January 2001, cost is 30,000. Okay, cost is 30,000. At that date, they have estimated useful life of 10 years. Boxer does not revalue this type of asset, but accounts for it on the basis of depreciation cost. 31st December 2002, 2 years, after 2 years, okay, the asset was subject to impairment review and recoverable amount is how much? 3,000. Is it right? It is after 2 years. They have calculated depreciation for how many years? They have calculated depreciation for 2 years and the carrying amount is how much? 24,000. Carrying amount is, they have done the recoverable amount is 16,000 and 8,000 is the impairment loss. 8,000 is the impairment loss. At 31st December, the circumstances caused the original impairment to have been recognized, reversed and no longer applicable. How much is the recoverable amount? Recoverable amount is 40,000. That means the value of the asset has been increased. Okay, the value of the asset has been increased. See what they have said, when it has been happened, it has happened on 31st December 2005. Again, how many years has been over? 3 years has been over. Okay, means it started from January 1st 2001. Here they have done for 2 years. Is that? Here they have done for 2 years and here they have calculated depreciation for how many years? 3 years. This is the carrying amount. Is it right? Carrying amount is how much? Carrying amount is 10,000. See, carrying amount is less. Recoverable amount is how much? Recoverable amount is 40,000. There is no impairment loss. Okay, carrying amount is less, recoverable amount is more. Now, they have initially how much they have the loss. Is it right? Historical cost is 30,000. Is it historical? Actually, we have to go by depreciation. Historic means we are doing for how many years? After 5 years. We calculate depreciation for how many years? Calculate depreciation for 5 years. See the things. Again, I am saying this. Little bit I will revise. Quickly I will not go. Okay. First, what we have done, follow step by step. This is step 1. Is it? This is step 1. Beginning 30,000, 2 years depreciation 6,000, carrying amount is 24,000, recoverable amount is 60, the 8,000 is how much? Impairment loss. This happens for the first 2 years. Okay, this is the situation on 31st December 2002. Okay, finish it off. This is step 2. Is it right? This is step 2. We have to start with the carrying amount. Carrying amount is how much? 16,000. Is it right? Now, is it? Carrying amount, the asset is returned down to how much? 16,000 and there is a impairment loss of how much? 8,000. Is it? Is 8,000 charged to profit and the depreciation charge per annum. See the things. Now what will happen? $16,000. Is it right? Now, they have revalued. Is it right? Recoverable amount is how much? 16,000. When they have recoverable amount, we have to take the revalued amount. Okay, we have to take the revalued or recoverable, the latest revised amount. I will put like this. You have to take the revised amount. How much is the revised amount? Revised amount is 16,000. Okay, this they have done when? This they have done on 31st December. Just now I told you, whenever you are charging depreciation, you have to charge depreciation on the revised amount. is that you have to charge any time you have to charge depreciation on the revised amount. How much is the revised amount? 16,000, is it right? 16,000. How many, what happened? Already 2 years has been over, okay? Already 2 years has been over. Now, how many years are there? We are going to calculate for next 3 years, okay? This is where, this is from 1/1/2003, is it right? 1/1/2003 to 31/12/2005. 3, 4 and 5. How many years? 3 years. Total years are how much? 8 years. How much you are getting? 6,000. Is it right? Take it. 16,000 times 3 divided by 8. It comes to 6,000. Now what is the carrying amount? Carrying amount is less, recoverable amount is more. If the carrying amount is less and recoverable amount is more, there is no impairment loss. Fine. This much is very interesting. Now, coming back to this. What is the historical cost? Historical cost is 30,000. Okay. Historical cost is 30,000. How many years has been over? 5 years. Okay. Total number of years are how much? The total number of years are how much? The estimated useful life is how much? 10 years. Is it? Estimate. Here also we have taken how many years? 10 years. But here we have taken how many years? In the second part we have taken 8 years because already 2 years has been over. Okay. Now, historical cost is 30,000. The depreciation as per historical cost, is it a depreciation as per historical cost? 30,000 divided by 5 by 10 years. How much is there? 15. Now what is the carrying amount after 5 years? The carrying amount is how much? 15,000. How much is the impairment loss? Impairment loss is 10,000. It has been happened in step 1. Is that impairment loss is how much? Impairment loss is 10,000. Is it right? As above. How much is the impairment loss? 10,000. Now, how much we can make a reversal? We can make a reversal of 5,000 only. Is that we can see the thing little bit advanced, okay, little bit advanced, okay. Initially how much we have calculated depreciation? We have calculated depreciation of 15,000. Is that we have calculated depreciation of 15,000. What is the carrying amount? What is the carrying amount? Carrying amount is 10,000. Is it right? This is the carrying amount. We cannot go beyond carrying amount. Is it? Carrying amount is how much? 10,000. The historical amount is how much? This is first time you are doing. The historical amount is how much? 15,000. Is that? Now we can take this carrying amount only. We cannot go beyond that. This historical amount, how we got it? 30,000 is the cost and depreciation based on this. How much is there? 15,000. The difference is now what happening? The carrying amount is 10. Is it? The revised carrying amount. Okay. The revised carrying amount is 10. As per the historical cost 15. How much is happening? There is a gain of how much? 5,000. There is a gain of 5,000. Just keep this one. I will do another 2 or 3 practice questions. Then it will be clear for you. Okay. First question, it will be really little bit, unless until we don't practice, we will not get. Don't worry about that. I am here to explain you this much. The rule says that you cannot see, carrying amount is 15,000. You cannot go beyond carrying amount. Okay. You cannot say that my asset is more than the carrying amount. You cannot increase the value of the asset. Okay, you cannot increase the value of the asset on your own. If you are if you are increasing the carrying amount, we are increasing internally. It leads to what? It leads to internally generated goodwill. The internally generated goodwill is not recognized. We cannot increase the value of asset on our own beyond the carrying amount. Okay, means we cannot go 10,000, we cannot go beyond 10,000. Okay, we cannot go beyond 10,000. Whatever is the excess of 10,000, that is going to be treated as a gain. Can I stop here, please?
Yes, Doctor.